Hey friends, it's Charlie with Cameron Capital Partners. I just want to answer what is a multifamily syndication and how is a Cameron Capital Partners syndication fundamentally different from other syndications out there? Well, syndication is just a fancy word for a partnership where there's money raising involved. In this case, there's two groups of people that come together to mutually benefit one another. There's the experienced doers, also known as the general partners, and there's the passive income seekers, or the limited partners. So if you take a look at this slide, excuse my slideology, I kind of threw these together based on a webinar, but on the left are the general partners, or the doers. Now, they do all the stuff, all the work involved in buying a multifamily property, managing it, selling it, in our case, trading up into a larger one. There's a lot of wickets and things to do and stuff involved in this. And you can see a lot of those on the left side. And on the right side are the folks, the passive income seekers. They're the people that want to be a part of an opportunity like this and to reap the financial benefits and returns and tax benefits of a multifamily property, but not necessarily do any of the work on the left side on a day-to-day basis. They may not have the time, the know-how, the experience to go out and do something like this on their own, and it might be difficult to do something of this scale as an individual. So these folks are more looking for passive income month to month and want to be a part of a deal like this. So this makes a perfect partnership. And the way this usually shakes out is the limited partners end up getting a majority of the deal, and the general partnership ends up getting a minority of the deal, though they're the ones doing the work and controlling the deal. So how is a Cameron Capital Partner syndication different from others out there? Let me first talk about what a typical syndication for commercial property looks like. Investors pool their money, they buy a property. Usually there's some value add play to it, some repositioning, renovations, increased rents along the way. And then after 5 to 10 years, depending on market conditions and when the property is ready to go, the property is then sold. Along the way, during that time before it's sold, investors are generally paid out a nominal decent rate year to year, quarterly, whatever that may be. Maybe it comes out to 8% a year. And then at the end, when the property is sold at the new price after the value has been added, investors are then paid out the additional return on their investment as well as their initial investment. And we'll say maybe they made a 17% total return on that deal by year. So we're structuring things a little differently. When you do that whole buy it, sell it piece, you leave investors with this gap. There's this part where, hey, now I don't have a passive income coming in anymore. I have to find somewhere else to invest my money, which is all fine and good, except that when that property is sold, the investors who are going to get their money back now do have to pay long-term capital gains. That's just a fact of life. You always got to pay your taxes, and that's fair. Now, we're structuring things differently. What we plan to do with each sale is then go and purchase a larger property with that equity. So here's how that works. We sell a property and we use what's called a 1031 exchange or a Starker exchange, where we basically roll the funds from that first property into the next one without touching it in between, so that the capital gains are now deferred onto the sale of the second property. See how that works? So on the first property, you're not going to pay the capital gains on the sale. Instead, it gets rolled into the next property. So this is interesting because on the properties we're looking to do something around doubling our equity. So let's say we put $500,000 into a deal, and by the time we add our value after, let's say, 5 years, we've got $1 million of equity in it. Now we can go buy twice the size property potentially, without adding any more money to the deal, because it's worth that much more. And we're not paying any taxes on the in-between transaction. We can go double our property size, double our monthly passive income that we're all gaining, and make more money. So there's a lot of power behind deferring taxes and deferring taxes and deferring taxes and never paying that big chunk in between. This is a totally legitimate thing to do. It's a really cool thing that is only allowed really in the US, if you look globally. So we want to leverage this piece. It's what I'm doing personally, and it's what I plan to do in Cameron Capital Partners. So the coolest part about all of this is that the return on investment increases over and over. So We're creating a continuously growing passive income stream for investors rather than a payoff, pay the taxes, find a new investment, jump back in, right? Now there's gonna be some interesting ways to go about this. We have to structure it pretty well, but this will still allow people to exit or enter the deal in between. You have to get all that laying flat, but generally the majority of our investors, we're going to be asking to invest for the long haul, for the passive income piece, rather than the payout. Now we are looking at doing both types of syndications in the future. However, initially we plan to be going down this route. And of course, things can always change. If it makes more sense to do one thing versus the other, and we will of course listen to what our investors want to do, then we will make adjustments as necessary and as the market dictates. Okay, I hope that was useful and you enjoyed that. Just remember, our mission at Cameron Capital Partners is to grow passive income by affordably housing Americans together. If you're interested and want to learn more, just hop on to facebook.com/Cameron Capital Partners or shoot me an email at charlie@CameronCapitalPartners.com. Hope to hear from you. See ya.